Good morning. I'm Ryan Chester. I run the annuity department here at BGA Insurance. I see some new faces on the list. I see some faces that I recognize, either have done business with in the past or currently do business with. So thanks for taking the time out of your morning to do this. I got to tell you, I work with advisors every single day, primarily on annuities. And there seems to be a lot of misconceptions or misunderstandings about income riders and how they really work. So I thought, why not do a quick webinar on how income riders work, a 101 course, something basic, 30,000 foot overview. So you guys understand some of the more critical components that create the income. How do these things really work? So let's go ahead and get into it. All right. What is an income rider? An income rider is an optional benefit attached to an annuity that allows an individual to create a guaranteed lifetime income stream or personal pension. Because the annuity is not being annuitized, the owner always maintains in control of the cash value. So think about if you worked at Coca-Cola for 40 years and were offered a pension. At retirement, you would be able to choose taking an income stream that would last for your entire life. But with a traditional pension, you don't have the luxury of also having access to the cash value. So if something comes up and there's a liquidity event, whatever it might be, you can't go to the company with the pension and say, hey, I have an issue, I need $20,000. They're going to say, I'm sorry, you're going to get your monthly or annual payment for the rest of your life, and that's all you get. With an income rider on a fixed index annuity, it's a bit different. It's the same in that we're able to create that same lifetime income stream, but the biggest critical piece is that we are not giving up that cash value. We're not giving up the liquidity. You always have access to that cash value should you want or need to tap into it. So that's really, really important and a big differentiator between a traditional pension and using an indexed annuity with a lifetime income rider to create that personal pension. So let's move on. All right. So there are three components to an income rider that determine guaranteed lifetime income. There's the bonus, there's the roll-up, and there's withdrawal factor, okay? These are all ingredients to that guaranteed income pie. And let's start with the bonus because there's a lot of misconceptions with annuities and bonuses. There are bonuses that are premium-based, and those are typically single-digit bonuses. Sometimes they're a little bit more, but for the most part, they're single-digit. But then there's these other bonuses that are applied to the income base. All right, these are the income rider bonuses, and those two different types of bonuses are very, very different. All right, these bonuses that are applied to the income base are double-digit bonuses. They're very attractive on paper, 10, 15, 20, 30, 35%. Okay, so when you see these bonuses out there that are really, really large, it's important to be able to understand, is that a premium bonus, like real cash, or is it a benefit or a bonus to the income base or the income benefit? Those are not real cash, okay? As I mentioned, they'll range anywhere from 10 to 30+%, all right? But it's not like you can surrender the contract and walk away with that money. All it does is create a larger income base, and the income base is just a phantom number that determines guaranteed lifetime income. So the first component, very, very, very important, is bonus, okay? Bonus. The second piece is going to be the roll-up, okay? The roll-up is a guaranteed growth rate that's applied to the income base while in the deferral phase. Now, you will see bonuses that accrue on a simple interest or compound interest schedule, all right? Some are as low as 4% before Lincoln got rid of theirs. Theirs was 4%. And some roll-ups are as high as 10%. Generally speaking, when you're going to see a roll-up at a 10% level, they're typically going to be simple interest. For the most part, 7% is going to be about the highest they're going to see on a compounding basis. But when you look at this screen, you can see that the income base under the blue heading, and then the accumulated value. So this is just a snippet of an illustration that I thought it would be good to include, because you can see the difference between the accumulated value, which is actual cash. It's real cash. If you want to walk away, you could take that value, but then the income base. And remember, I said those really, really large bonuses are going to be applied to the income base. And then also this roll-up comes into play in the deferral phase. So every year the client defers taking income, they're going to enjoy this roll-up, this guaranteed growth rate. And there's a lot of misconceptions. Actually, I had an agent that was reaching out to me before this webinar, and he was asking, hey, what company out there has a 25% bonus and a 10% guaranteed interest rate? And I knew exactly who he was talking about. And it's actually this product, oddly enough, Athene. They have a 25% bonus to their income base and a 10% roll-up. Well, he was getting confused, thinking that 10% guaranteed growth rate was to the cash value. Okay, so I had to make it very clear, like, that's not to the cash value. It's simply to this income base, which is not a value you can walk away with. So it was very timely in the question, but there is a lot of confusion with that. And I know people get missold, and it's not necessarily because the agent's trying to defraud anybody. It's just the sheer fact that the client misunderstood what the agent was saying, or maybe the agent just simply didn't understand how the product works as they were presenting it. So this roll-up, again, is a guaranteed growth rate applied to the income base every year that you defer taking income. So look at this blue column. This blue column, these values are increasing by 10% simple each year until we start taking income. Then you can see instead of 233, it starts to drop off as you start taking income. So again, guaranteed growth rate during the deferral phase only, not real cash. Very, very, very important. All right, withdrawal factor. This is the third piece, and this is a really, really important piece of how it works.
Okay,
So
I want to get the spinach egg
withdrawal
wrap,
factor,
please.
bear with me, I mute.
No, that's all.
Sorry about that. Guys, if you can stay muted, I appreciate it. Thanks. The withdrawal factor. So it's the percentage of the benefit base that's allowed to be taken annually. All right, it increases based on income start age. So the older you are, the higher percentage of the income base you're able to take each year. And here's an example. This is actually an AIG case I was working on last night, so I figured I would snip it out and throw it in here. But you can see if you started income anywhere between 50 and 60, you're able to take 4.5% of that income base per year, versus if you were 75 plus, you'd be able to take 7.5, which is going to create more annual income. Now, this I feel like is a piece of the pie that's overlooked, and maybe most important out of all three factors, because what good is it to have this giant pool of money if we can't access it, right? I mean, you might have $1 million of assets that you're able to tap into for 1% a year. Okay, great. But then there might be another asset that's only 250,000, but you can tap into 10% of that per year. So, there's more to these lifetime income riders than just the bonus and roll up that the insurance companies want to promote, because those are the sexy approaches that gets people's attention. But this is a very, very important piece of it. And we'll take a look how it all plays together in just a moment. All right. Payout type is something that you need to be aware of. Most of the companies in our industry offer a level income stream. Okay. We start income today, and we're going to get X amount for the rest of our life, and nothing's going to change that. The stock market's not going to change it. Fees aren't going to change it. Nothing's going to change it. It's level for life. Okay. Like a traditional pension would be. Okay. But some companies offer an increasing income stream. And the way that those work is that anytime the index has positive performance, the lifetime income amount is going to benefit from that and also increase by the performance. So you can see in this example, this is a company that offers both level and increasing. And it's really neat because with most companies, you have to make the determination. Am I going to go with a product that has an increasing income option or a level increasing option? You got to choose that issue. Okay, so you're banking on my decision today. I'm gonna really, really, really want that same sort of income 10 years from now when I'm going to start taking income. And that's not always the case. Things change. So when you look at these two columns, it's important to understand if you're going to go with an increasing income option, you're going to start at a lower level than you would have if you chose a lifetime level. Okay. So for your clients that just need every penny they can get and they can't afford to have any variability in their income, oftentimes it's not a great idea to go after the increasing income option, because you can see in this example, this client would have had the choice of taking, say, $40,000 of income for life level, or let's call it starting at $33,000. Well, you can see that on this far right column that we exceed the $40,000 in only a couple of years. But that's based on the market's actually performing. If they don't perform, then you're not going to get those increases. So it's not guaranteed. Whereas if the client would have just taken the 40 up front, they would get that forever. But for those clients who can afford to take a little bit less starting out for the opportunity to receive far more in the long run, it's a really, really good idea to at least explore what an increasing income option looks like and talk to your clients about it. Because you can see, based on historical performance within this contract, the difference is staggering. It's more than 4 times as much income should you have gone the increasing income route. But again, not all clients can afford to take less money up front for the opportunity to get more in the end. Okay. The other thing is the insurance companies allow you to choose single or joint life payouts. I would say 98% of the business that we see is all done on a single life basis. But I think it's a huge mistake when advisors are not exploring or talking to their clients about joint income. I think it's a really important piece that not enough advisors are taking into account. Because look, at the end of the day, I understand competition's real. And so if you have a client who's got $250,000 and they want to use it for lifetime income, you're worried about another advisor coming in and providing them something that creates more income. I get it. You don't want to lose the sale. And single life income is always going to show higher income because it's based on one life. So I get the rationale behind it. But at the same time, does it make sense to come in behind that and say, look, here's what we can do on a single life, and this is the very best in the industry. This would provide you the most income. But if you consider the risk of at your death not having enough income or assets to support your spouse, you might want to consider a joint income option where instead of $40,000 a year, maybe it's, I don't know, maybe it's $32,000. I don't know what the real number is. I'm just making stuff up. But, that's one thing. If you guys are in this space or looking to get into this space, really think about the value of joint income. It's not being talked about enough. And it should be. It really should be. All right, bells and whistles. So there's 2 things that you're going to see on different products. Some have it, some don't. I don't think these are these aren't why people are buying the annuities, but I think of them more as a cherry on top. Okay. The first thing is an enhanced death benefit. So when a annuitant dies, an annuity is passed to the beneficiaries. The beneficiaries on a normal contract would receive whatever the account value is. It's the remaining cash value in the policy. Now, there are some products that have an enhanced death benefit where they will receive some greater amount than the cash value, which sounds great. It's not underwritten like a life insurance policy, but it's not tax-free. It's just some extra money. But the big key thing in here is it's payable over a 5-year period. You can't take it lump sum. So the insurance company says, hey, beneficiary, would you like to receive X lump sum, or would you like to receive this enhanced value over a 5-year period? And just because it's paid over a 5-year period doesn't mean there's anything bad about that. In many cases, it's often a good thing because maybe the beneficiary has enough money. And by taking that benefit lump sum, maybe that would have pushed them into a higher tax bracket and it would affect their overall, their taxes overall. Whereas maybe on a 5 or 10-year payout, it keeps them with under that threshold. They're still getting the money, but it's not having a negative impact on their tax bracket. Or maybe beneficiary is not responsible enough to take the money lump sum, and maybe it's better to get spread out over 5+ years. So, it's not a bad thing. Just understand that when you see these enhanced death benefits, they are payable over a 5+ year period. The other thing is enhanced income. We call these income doublers. And what happens is the insurance company says, listen, what will happen is if you're taking your guaranteed lifetime income stream and you have a long-term care event, maybe you become unable to perform 2 out of 6 activities of daily living, or maybe you're confined to a nursing home. Different products have different qualifiers, but if you're able to satisfy whatever that trigger is, we will double your lifetime income for a certain amount of time, and they're different. Like F&G is an example. 2 out of 6 activities of daily living. They will double it for 5 years or until your account value hits 0, whichever comes first. Again, this isn't true long-term care. It's not tax-free, but then again, it's not underwritten. Every policy has this, okay? This is the cherry on top. It's like you're getting ice cream sundae. That's great. And here's a cherry on top. Everybody likes the cherry on top of the sundae, but we're not buying the sundae just for the cherry. So, I wouldn't use this to do any sort of true long-term care planning. But it is cool to know that we have this asset over here that might potentially pay out some additional funds to help for the cost of care if the client becomes unable to perform 2 out of 6 activities of daily living. It's really, really cool. It's a nice benefit. Cost. In general, the cost is going to be somewhere around 1% for these riders. Now, here's what a lot of people don't know. It's 1% of the benefit base, not of the cash value. Remember that benefit base is the amount that gets that big bonus, that gets that guaranteed growth rate. It's generally a lot higher than the cash value. So don't go into these things thinking, oh, it's 1% of the account value. It's not. It's generally 1% of the benefit base. Not a bad thing. It's just important for you to understand this because most people don't even realize it. When you take income from an income rider, it reduces your cash value on a pro rata basis, okay? You take a normal withdrawal from your account, it's going to reduce your cash value dollar for dollar. It took $1,000 out, my cash value is $1,000 less. Income riders don't work that way. They're going to drain that cash value faster because it's pro rata. And I don't know what the pro rata calculation is on it. Maybe it's 1.2 or 1.3 times or something like that. But understand, you take that $10,000 distribution via the income rider, your account value doesn't just drop by 10,000. It's going to be more. Okay. But it's important to understand neither of these two things have any effect whatsoever on the lifetime income amount. It could have a 50% fee and reduce the cash value within 2 years to 0, and it would have 0 effect on the income. Okay. It just has effect on the cash value. And the only time that matters is if you decided to surrender the policy because you would have less cash value, or at death, when that benefit passes on to the beneficiaries, they do receive that cash value. So there is lesser amount in that bucket for them. So keep those in mind. Very, very important. Most people don't realize this. Okay. Don't get lost in the sauce. I talked about bonus, roll up, and withdrawal factor. I can't tell you how many times I get called from the agents and they say, hey, who's got the biggest bonus or who's got the best roll up? Like, who cares? It doesn't matter. All right. All this stuff is marketing. That's all it is. All we care about is who's going to put the most money, the most dollars in your client's pocket. Okay. I thought this was interesting. If you look at this graphic over here, this column's the roll up rate. This column is the withdrawal factor. This benefit rate column is the withdrawal factor. And then you can see on the far right is the income, the annual income each product would provide. And you notice a couple things. If you just came to me and said, hey, Ryan, who's got the biggest bonus? I would say, I don't know, Allianz's 222, I believe, is like 35%. But that doesn't mean it's going to create the most income. And in fact, you can see right here, this product with a 30% rider bonus isn't number one. It provides $1,000 less per year than the number one product that doesn't even have a bonus. Okay. If you look at the roll-up rate, 10% roll-up rate happens to be number one, but it's not based on that alone. But you can see that there's products that have, okay, perfect example, this 30% bonus with only a 5.77% roll up. It creates more income than this product with a 8.5% roll up. Okay. These ingredients on their own don't mean anything. It's just the ability for an insurance company to say, we got this great bonus, 30%, come look at us. People get excited and sell product. Like, that's cool. That's fine. I understand they're trying to get business and they got to figure out attractive ways to do that. But it's important to understand, like, any one of these three components on their own doesn't mean a single thing. When you look at the benefit rate, this is the payout. So you can see that this number one product, although it doesn't even have a bonus, it has the highest withdrawal factor. And because of that, it's creating the most amount of lifetime income and by a wide margin. Okay. Conversely, you're seeing products down here like the last one with a 7.6% withdrawal factor, which in this example is the third highest, but it's the last in terms of income. So the whole point of this stuff is don't worry about bonus, don't worry about roll up, don't worry about anything. Let's just talk about who creates the most amount of income, and then we can talk about the details further. But that I think is really, really important. So look, annuities are unbelievably hot right now. Our production is through the roof this year. Products are always getting better. The positive interest rate environment is definitely helping us. So if you have clients in mind where you think, hey, I think maybe I should talk to this client about an annuity. I want to talk to this client about lifetime income. Give me a call. Let's chat about it. I took up enough of your time. We're looking at 25 minutes. I hope you guys found value in that. My 30,000 foot overview on income riders. I'm happier to go deeper with any of you on an individual basis. If you'd like that, reach out to me. My contact number is right here on the screen, 949-385-7225. That's my direct. Shoot me an email. I look forward to talking to you all.